Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This video will look at slow growth stocks, companies that are growing earnings at lower than 5%. A prime example would be utility stocks. When calculating fair value on a slow growth company like a utility stock, we'll use Southern Company here as our example. We use a formula that was made famous by the legendary investor Ben Graham, and we call that GDF, or the Graham-Dodd formula, as you can see in the orange box here to the right under the Fast Facts. When you look at Southern Company, you can see that the earnings growth rate, which is shown in the green rectangular box here, has been 3.2% since calendar year 1999. But the orange line is drawn or created by applying Ben Graham's famous formula, which you can easily look up in Google. And you can see here that that line in this example represents a PE ratio of 15 times earnings. So anywhere you look at this orange line on this graph, you would be looking at 15 times earnings. The blue shaded area represents the dividends that are paid out of earnings, and you can see that Southern Company pays a very large portion of its earnings out as a dividend. However, we also see that the market has capitalized the company's earnings. In other words, the price tracks earnings and tracks all of the earnings. So in the case of a company like Southern Company, you're going to see that the growth rate of price is very low. It's going to average something close to the 3.2%. But the important point here is this graph really depicts that you really never want to pay much more than 15 times earnings. And you can see as Southern Company became overvalued, meaning the price was above the orange line in calendar year 2012, how the price has since reverted back to the mean. The normal price earnings ratio, or the blue line, is very close on this graph because the market has historically priced this company somewhere between 15 and 16 times earnings. So obviously what you can do by looking at this graph is very quickly determine when it was the good time to buy this company. You also recognize you're not going to get a lot of growth, but you're primarily buying this stock for the dividend that it produces. So when you're looking at slow growth stocks like utility stocks, FastGraphs gives you a real good indication of when to buy, sell, and hold. Our second example here would be Scanacorp, another low growth utility, and once again you see a 15 PE ratio connotated by the orange line, and clearly the best time to buy this stock is when the price is below the orange line. In this case, the blue line and the orange line are also, once again, very close. So the market, has typically priced this stock at 15, and you wouldn't want to pay a higher multiple and buy it. Currently at a 15.3 multiple, it's arguable that it's fully valued to maybe even very, very slightly overvalued. We also learned from the Fast Graph by looking at the Fast Facts, the company has a 4.2% dividend yield. Again, we see the growth rate is 3.2%. What we see in the green shaded area, you can point to these areas and you'll see a pop-up window that'll tell you, what the areas represent. The company is a multi-line utilities. It has a $6.3 billion market cap. Company has 55% debt to capital and trades on the New York Stock Exchange. Hopefully, you can see how FastGraphs reveals a great deal about the value of the business, the operating history of the business, and when to buy, sell, or hold the business at a quick glance.